So just a little context here. I'm teaching this program today for the University of Arkansas School of Law. And this presentation is part of a very large project providing national taxpayer education with money that came out of the American Rescue Plan to direct funds to the USDA for a variety of programs for support for independent farm and ranch operations. And within that, there's this project called the Agricultural Financial Tax and Asset Protection Program. What a mouthful, but that's what it is, AgFESTAP. But it's, mouthful aside, great resources from a bunch of universities around the country working to get this material out to you. So stay tuned and get that website in mind. And here we go with this partnership with the USDA and the University of Arkansas. So this is a big picture overview of farm and ranch tax issues. You all know people spend their entire professional lives just on this topic, right? So there's nothing we could do in an hour and a half that's possible any more than just a big picture overview. But I'm going to try to hit on the big things that I think you need to have in mind to manage your strategy for how you manage taxes. So this is what we're going to cover. And we're going to cover this all really brief, high level, but enough to get you going. Different types of taxes. Critical thing, the profit motive and the hobby loss rule. I saw from a little preliminary poll of who was here tonight and why, but there were a number of people here tonight who were still sort of exploring and planning. What a great time to come to a tax class. Yay for you who have come early. For those of you who've come late, don't worry, we've always got tricks for how to get you fixed up, even if you're a few years down the road. But being early and proactive in your planning is so important. And we'll talk about the profit motive and the hobby loss rule and how that affects you as you set your business up. We'll briefly touch on entities. Remember, I butted in on Ashley a minute ago to say there's no such thing as a loan if you're a sole proprietor. I was making that distinction between a sole proprietor and a partnership and other kinds of entities. That's a whole giant chapter, many chapters of law right there, but I'll touch on it tonight to give you some of the language. I saw some of the preliminary questions were about what kind of an entity do I need to be a farm? So we'll touch on that. We'll definitely touch on how to get help with tax preparation because none of you are going to be doing this on your own manually on the forms. That's just not a way to do it. We'll mostly focus on the high level, what is the tax formula for an individual, so you can see where the farm or ranch income comes into your personal tax return. And then finally, we'll look at the special rules for certain things that are particular to farm and ranch. And these are the things that if everything else is good and you've got a tax preparer and you've been in business before and you're doing everything right, this is still the stuff you'd miss on a farm or ranch because it's very specialized to farm and ranch. All right, so here's the first thing. Property taxes, that's county level. I'm not going to talk about it anymore, except for a couple times I'll touch on it. Sales tax, that's county level. We just talked about it with Ashley. We're done with that topic for tonight. State and gift tax, huge topic, incredibly important. Not talking about it tonight, we're done. But it's a huge topic. You have those issues, stay tuned, but not tonight. Payroll tax, another giant topic. If you have labor, payroll tax, complicated, hard to manage, hits bookkeeping, hits lots of things. We're not talking about it tonight. State income tax, that's a big issue too. Mostly state income tax follows federal. Mostly it says, what's on your federal return, add this, subtract that, here's your state income tax based on your federal income tax. So if you're not actually a tax preparer, you don't need to worry about this Arkansas specific state tax rules. You just worry about federal, and the state tax is sort of automatically generated from that. And then just technically some licensing fees are considered taxes, but that's not particularly important. All right, so we're talking about federal income taxes for the whole rest of this time. Federal income taxes is what this is about. Here's where we start. You have to have a profit motive to be filing taxes as a business. Otherwise, it's a hobby. So what is a profit motive? It is either annual profits, that comes off of your income statement. That's income minus expense equals your net income, annual profit, money you can use to maybe go on date night or go on a vacation or whatever it is you use your profits for, right? Or long-term increase in your net worth due to the increase in the value of assets. That's your balance sheet. That's the balance sheet. Those are the assets you own going up in value over time, and your effort building out your farm, building out that property, improving the soil, the fences, the irrigation, the trees, the buildings, all that sucks up money, right? It leaves you cash poor during the year. It might leave you with losses on your tax return, but that property is going up in value faster than just the market going up, right? Faster than if you just left it alone because you're improving it. Either of these things equals a legitimate profit motive. But if you have neither of these things, you're not a business and you can't file your tax returns as business tax returns. So the hobby loss rule says that you can't take any tax losses for a hobby. So if you're improving your property, spending money on fences, irrigation, soil, etc., losing money, right? The money's going away, the income's not coming in, but the property value is going up. You have to demonstrate to the IRS that there's a profit motive in those activities, as opposed to, I just really like living in a beautiful property in the country. And I just really like white fences, and I really like having a pond, and I really like looking out the window and seeing some flowers growing and some pigs and chickens. It just makes me feel so good. That's a hobby. Could be almost the same exact thing, depending on how you demonstrate your motivation in what you're doing. If you are losing money in 3 out of 5 years, then the IRS has the right to come in and make you demonstrate to them that you have this profit motive. And if you can't, what it means is you can't take the losses against other income. If you somehow had income from a hobby, you would have to pay tax on that income. And that's not really the issue. The IRS doesn't care that much about that. The issue is if you're having losses and you're trying to deduct them, the IRS wants to limit that only to businesses that have a profit motive, and those are not hobbies. I want to caution you another thing about the hobby loss rule and tax preparers. Many of you may be coming into planning for your business with true profit motive, but it's a second business. You're not going to do it small time. It's going to be very small. Some of you may be in communities where there are large, successful, full-time farm and ranch operations. Hobby farmer, in my experience, is often used as a derogatory term. And I have much personal experience with tax preparers telling beginning farmers who are going to be small farmers, part-time farmers, oh, you're just a hobby. Oh, don't worry about it. You're just a hobby. You're not a real farmer. And some of that is the tax preparer doesn't want to do the work of preparing that farm tax return, because it might be quite a lot of work to prepare a proper farm tax return for a very small farm. And the tax preparer doesn't want to just come out and say, I'm too lazy to do your tax return. So they say, oh, you can't do that. Or they say, oh, you'll never be profitable, and so you shouldn't take the losses because you'll get audited. So a lot of what I'm going to talk about the rest of this evening is the benefits to being able to legitimately take those losses if they're legitimate business losses that are on the path to when your business becomes profitable. It's really rare for a farm to be immediately profitable, and it's super common for a farm to lose money in 3 out of 5 years while trying to make money. So don't let anyone call you a hobby if you're not a hobby. But, you know, I want to help you know how to show that you have that profit motive. So there are about 9 or so factors, but these are the ones that really matter. The other ones really don't matter, unless you're like me and you like reading the court cases for fun. Here's what really matters. You have to have some sort of a plan to sell your product for a price greater than the cost of production. So if you just sort of vaguely, like, I'm going to grow stuff and it's going to magically get itself to some market somewhere and I guess someone will buy it, that's not a good indication you have a profit motive, right? Number one rookie mistake as beginning farmers is that they don't know their market. People like me say you shouldn't put a seed in the ground until you know where it's going to be sold. So same standard for the IRS, showing a profit motive. You have to be able to identify your plan for where you're going to sell your product. Nobody cares that you can grow a lot of lettuce. Anybody can grow a lot of lettuce. What they care about is your plan to sell that lettuce, and that's what's hard, and that's where you do or don't make money. That's item one. Here's item two. Everything Ashley just said after she stopped talking about Excel and shoeboxes. Once she started talking about the bookkeeping system, everything she said, right? A standard bookkeeping system appropriate to the scale of your operation. If you're a small farm and you have a profit motive, a shoebox is not appropriate to your scale. You need to be moving to a proper bookkeeping system to show that you have a profit motive. It's not an automatic out, but it's definitely not an automatic in your favor. It would make it very, very hard to prove it if you were at the shoebox level. And then the last one is that you're regularly, because you have these records, right? Because you have the records that come out of your bookkeeping system, you can look at your balance sheet where all your assets are, and you can look at your income statement where your income and expenses are, and you can use your brain and say, oh, we sold a lot of cherry tomatoes, but we weren't actually that profitable on cherry tomatoes. We were super profitable when we sold that pork, but we didn't sell as much of it. Maybe we should change our operation and put a little bit more energy into the pork and a little bit less energy into the tomatoes. Right? That's managing your business with a profit motive. So you have to be able to show that you're doing that you're actively managing, making changes, responding in a way that you may get it wrong, right? You could guess wrong again. That's not a crime, and it doesn't make you a hobby. But you're trying to guess correctly and move to where you're going to be profitable. And then closely related is acquiring and continually updating appropriate knowledge. And that is you right now, right? So a record that you would keep that you attended this class is good evidence that it's not a hobby, because people don't usually sit through 2.5 hours of a conversation like this as their thing they do for fun, right? That's a thing they do because they're serious in their intent to make a profit. All right, so quickly about entities. Like I said, I'm sorry, I can't go deep on any of these tonight because we're just trying to give you a big overview. Basic questions about entities and filing taxes. Sole proprietor. You wake up in the morning and you say, I'm going to start a business, and you do something, anything about it. Congratulations, you're a sole proprietor. You get any money from that business activity, you have to report it. You report that on a regular 1040, which is what individuals and married couples file, Form 1040. You get smart, you take a couple classes like this, and you go down and file to become a limited liability company because you understand that that may limit your liability if you are sued. For tax purposes, you're probably, as a single member LLC, you're going to choose to be what's called a disregarded entity. And you might not even choose that. You might even not even know, you just do it accidentally, but basically you just keep filing exactly the same as if you hadn't formed the LLC, and that's correct, and that's a disregarded entity. So a single person, sole proprietor, or single person LLC, either way, they're filing a 1040. A legally married couple, not to be confused with two people who say, it's as if we're married, right? IRS doesn't care. They need you to be actually married, right? A legally married couple files a 1040. If they're both involved in the business and they both want to be paying into Social Security and Medicare, and I'll get to that in a minute, the details of that, but if they're both in the business and they both want to be paying into Social Security and Medicare, they would file their farm business as a qualified marital joint venture. That allows them to file one tax return, keep it simple under the 1040, but both pay into Social Security and Medicare. I'll talk about how more in a minute. The other alternative for two legally married people is they form an LLC and they both own that LLC together. That's the same as any other entity where there's more than one person, right? If there's more than one person and they're not married, that's an automatic partnership, whether you want to be or not, whether you knew it or not, whether you regret it or not. You wake up in the morning and you say, I'm going to go into business with another person. And the two of you do anything about it and get any money. Congratulations, you're a partnership. And you have to file a Form 1065. That's a partnership tax return. That 1065 generates a form called a K1. The K1 goes to the IRS and says, hey, IRS, these people are partners in this partnership and you should be looking for their 1040s. And on their 1040, they're going to report this same income that this partnership returns. Partnership doesn't pay any taxes, it just reports. Individuals get that K1, they put it on their 1040, they report, and they pay the tax. And that would be the same if it was an LLC of two married people filing as a partnership. So that LLC also has the option of making an election to become an S corporation. Not possible to do that accidentally. Somewhat difficult to do it on purpose, right? That's a very deliberate choice that you make. It's a form that you file. You have to file it on time. There's no way you should do this without having had a CPA run the numbers for you a couple times to figure out if the S corporation is actually the tax favored entity for you. Prior to the 2017 Tax Act, S corporation was tax favored for consistent self-employment income between $30,000 and $40,000. It made sense. Today, post 2017 Tax Act, the S corporation doesn't start to make any sense until you're definitely over $100,000 self-employment income per person. Up about 115, 120 is the soonest it would make sense to look at an S corporation as the correct entity. I know that what I just said is a huge amount of information. We will be posting this so that you can have access to these slides. Going to pause here if there's just a emergency confusion. Otherwise, we'll try to take questions at the end. Want to cover a little bit more about these tax forms before
I have a quick
go
question.
into the formula. Yeah, go ahead.
The S corp. I think when I applied for my EIN, I said S corp, but it doesn't really. Whenever I got my EIN, it doesn't really say anything about it.
Yeah, I couldn't give you a real specific answer there, but there's no way just doing that is enough to make you an S corp. It might be enough to have confused people and caused you some other problems, but it's not enough to make you an S corp. But to really know what would happen, you'd have to ask someone in regular tax practice.
Okay.
All right, I want to talk a little bit about the Schedule C and the Schedule F because those are common sources of confusion. So the 1040, it's a summary sheet that an individual or a married couple will file. The 1065 is the equivalent that a partnership files, and the 1120S is the equivalent that an S corporation files. All three of those have forms that attach to them. And the Schedule F is the one for farm. It attaches to any of those sheets. It doesn't just attach to the 1040. It could just as easily attach to a 1065 or to an 1120S. The Schedule C is where you report the detail of income and expense for any business other than a farm or ranch. The Schedule F is only farm and ranch, but they're similar in that it's income and expense detail. And then the Form 4797 is just where you report the sale of business assets. So if you think back to what Ashley was saying about bookkeeping, you're going to have one bookkeeping for your farm or ranch business. That bookkeeping is going to have your regular income from selling farm products, your regular expenses associated with that, and from time to time, you're going to buy and sell equipment, not because you're an equipment dealership, right? But because you need new equipment and you sold the old equipment to get the new equipment, and that's just the thing that happens on a farm or ranch, right? So that transaction is going to be recorded in your bookkeeping as part of your farm overall activity. But when you go to your tax return, those transactions that relate to the sale of the asset are going to be reported on a separate form, the 4797, and the rest of the activity is going to be on the Schedule F. So if you were to look at your Schedule F and compare it to your income statement, there might be a difference there, and that difference would be on the 4797. That's your incidental sales of tractors and other equipment that happened during the year. I don't say this like you're going to fill out these forms on your own, right? I say this because I'm thinking some of you right now might have your tax returns in front of you, and you might be flipping through them and trying to make sense from what I'm saying. Oh, yeah, I see that I filed a partnership tax return, and I see that K1 coming from my partnership tax return, the 1065, over here to my personal return, the 1040. Or yeah, I'd wondered why I could never make my Schedule F equal my income statement. This is why. And this is sort of the basic level of tax literacy that I think every business owner should have. The ability to get that tax return back from the tax preparer and at least have a basic orientation of how the tax returns, there may be multiple, right? How those multiple tax returns interrelate and what the important forms to look at that are attached to the first page. Then there's maybe 40 pages behind. Not all of those 40 pages are very important, but some of them are pretty important. The Schedule F, the Schedule C, and the 4797 are really important schedules that you definitely want to look at the details on them. A lot of the other stuff is just taken up paper and ink, and you don't need to look at it. All right, so why file a Schedule F? Gross income, not net, but gross. Gross is the income coming in with no expenses, just the income, no expenses. That number comes off the Schedule F, and it's used to qualify you for several special benefits that are only available to farmers and ranchers and sometimes fishers. These benefits include the ability to pay all your estimated taxes on March 1st rather than quarterly during the year, and the ability to qualify for special bankruptcy protections, which nobody ever wants to think about it's going to happen to them, but if it ever happens, you really want farm or ranch bankruptcy if you can get it. The ability to use income averaging, which is just specialized to the small group of farmers and ranchers, and that allows you to, if you've had lost years in the past, or if you have lost years following good years, you can go back and re-average it out and get a tax refund. It's a nice benefit. And then the ability to qualify for other state and federal programs often is tied to the Schedule F. Also, if you go looking for a loan from an agricultural lender, they're going to expect a Schedule F. If you don't have one because you've been filing everything on a Schedule C, it doesn't automatically mean they won't give you a loan, but you have kind of let them know that you're not maybe the most careful and sophisticated business person. So it just puts you in a better light if you know to start with a Schedule F, because that's what they're expecting. So what happens if you've been doing it on a Schedule C? Probably nothing. These are sort of in the details how much it matters. You're paying the same amount of tax most likely. So most likely the IRS doesn't really care. It's wrong, but it's not the kind of wrong that causes problems. But you can't take advantage of some of these other things. When should you file the Schedule C? So Schedule F is for all the activities related to producing crops and livestock for sale. Schedule C is for everything else under the sun that's legal. So that's agritourism, it's hunting, it's teaching classes, forestry design services. Those are all things that are often closely related to a farm and ranch. They take place on the same land. You may well be running them through the same bookkeeping and accounting system, but properly on your tax return, you should split it out, and you should only have the crops and livestock part on the Schedule F, and you should have all those other related activities on a Schedule C. The most important of these is value-added activities that are actually food and beverage manufacturing. And Ashley mentioned she had a little commercial kitchen on her property, so my little alarm bells went off, right? I don't know enough about her business to know if she needs to separate that activity or not, but I know enough when she said commercial kitchen that that's the beginning of asking that question. Is there something else going on there that's beyond basic crops and livestock for sale and getting into food and beverage manufacturing? Generally, that's processing a product beyond the minimum amount required to transport it. So Ashley can't just hand a cherry tomato to a buyer. That's not realistic. I mean, she could, but nobody's making any money that way, right? The buyer expects at least that the cherry tomato is clean and they're going to put it in a bag, some sort of a basket to get it transported. But she doesn't need to make it into jam or sauce or jelly or soup or juice to get it sold. So those things are all clearly beyond raw agricultural commodity. Where it gets tricky is with small livestock. I know a lot of you are looking at small livestock. Typical big farming operations, they're going to be selling a live animal or a whole or half carcass. And that's clearly the end of farming. And then everything that happens after is a different business. With small direct market, farmers market-based animal agriculture, typically it's a basic cut and wrap, often cut, wrap, and freeze, right? So you're selling a frozen meat cut that's small enough that a consumer like myself can actually buy it and take it home and fit it in their freezer, because my freezer isn't going to hold a half a steer, right? Mostly that's all going to be considered still simple farming and ranching, but for sure by the time you get into making sausage or charcuterie or meat pie or soup or any of those things, you've definitely crossed over. You've moved away from farming and ranching and into food manufacturing. And so properly, that income should not be on the Schedule F. So what happens if you're putting these things on your Schedule F? Is it bad? Probably not. Could be. So I just want to walk you through when it might be bad and when to, how much should you care? You're basically overstating your gross income from farming and ranching activities. Is that a problem? It's not unless you're using it to your advantage for something that you're not actually entitled to. So if you're using it to only pay your estimated taxes once a year, then that's a problem. If you're using it to qualify for reduced property taxes, because you're saying you're mostly farming and ranching, but actually you're mostly manufacturing, that would be a problem. Related, if you have an agricultural easement, something that says this property can only be used for these commercial purposes, which are farming and ranching, and they can't be used for these other commercial purposes, such as an Airbnb, that could potentially be a problem. And any other time you're using that overstated farm income to apply for something that you wouldn't otherwise qualify for. Other than that, it's not that much of a problem, but I would just say from a business management perspective, you want to keep an eye on it and know that if you're going to continue down that road of this value-added manufacturing, one of the things you have to be planning for is to separate those businesses for multiple reasons, tax just being one of them. All right, I'm going to take a deep breath. I know I'm going fast, but it's because I really want to make sure we have a lot of time at the end for questions. Anyone's head just exploding right now and you have an urgent question?
Poppy, we have a question in the chat. A couple. Alice asked, what would selling products like kitchen and home garden appliances be put on a Schedule C or a Schedule F?
Yeah, so that's a great example of, and I'm going to talk about this a little bit more, so stay tuned. This is coming up a little bit more for tax purposes, but I would say if you put it on the Schedule F and you are not using your gross farm revenue to qualify you for anything that you might not truly deserve, then there's really no problem. You haven't done anything wrong. It's like, you know, you made a spelling error in a sentence or a little grammatical error. Everybody knows what you mean. It just has a little error in it. It's not the same as if you said turn left when you meant to say turn right. You just spelled light incorrectly. So yeah, I mean, those things clearly are not farming and ranching activities, but if it's small, if you haven't really turned into a full-blown gift store, it shouldn't be a problem. But again, you keep an eye on it, because if it's growing, and you wake up one day and you realize, you know, it's really kind of more of a gift store than a farm, or it's at least as much a gift store as a farm, then for many reasons, including tax, it's probably time to separate it into a separate business. I'm going to talk about that a little bit more when we talk about supplies inventory. It's going to be almost at the end of the presentation, but stay tuned again. Under inventory is going to be the second half of that answer.
Thanks, Poppy. And then just one more clarifying question. So a Schedule C and a Schedule F could possibly be filed for one farm's activities.
Yes, absolutely. Yes, yes, correct. Ding, ding, ding. You understood what I was saying. And again, like, I don't want to get super deep, but that's the level of understanding I for sure want you to have. Yeah. And to add a little finer point on that, if you were, let's say you have an apple orchard and you make apple pies and you realize that apple pies are clearly beyond farming, what you're going to do is you're going to sell yourself the apples, right? You're just going to sell the apples from the farm business to the pie business. The pie business buys them in as raw materials, and off you go from there into an advanced inventory accounting class, which we will teach some other day. Good for now?
Yep, I think
right?
so.
Help. This is the place where people say, help, help, help. How am I going to get help? Yeah, so you definitely want help with this. I want to be really clear that there are always exceptions, right? So I certainly have met some really great professionals working at H&R Block and Jackson Hewitt, but I'm presenting here sort of in order of my preference for how you would get help. The franchises are really after speed, and the only way you can get speed is if everything's the same, and you are not going to be the same, right? Anytime you're doing farm, just the fact that it's Schedule F, right? Just the fact that we had this whole conversation, you slowed them down a lot, right? They're just doing Schedule C, self-employed all day, every day, this time of year, till their eyes are crossed. And when you come in with a farm, their eyes have to uncross in a different direction. That's where you're likely to hear them say, oh, you don't have to worry about that. It's a hobby loss, right? Because they really don't want to deal with it. So most of the worst mistakes I've seen, most of the people I've seen with just like the tax returns that made me the saddest and that they were going to have to do the most work to fix, they had gone to one of these seasonal tax preparation outlets and not asked the right questions and not spoken to the right person, and they got a really bad result. Again, there are some people that work year round, particularly in rural communities, who do know farm and ranch taxes and who are wonderful, and I mean them no disrespect, because they provide a really important service in their community. But caution there, right? So if you do go with one of those services, make sure that you're actually making eye contact with someone that is happy to have you and your Schedule F. Otherwise, I would say you're better off, if those are really your only choices, if you're really convinced you cannot afford more than the cheapest possible services, you're probably better off using tax preparation software yourself. H&R Block or TurboTax for self-employed. Both of those programs do a perfectly good job and are at least as likely, if not more likely, to get, because you're using them, right? And you care and you know more about your business and they're asking the question sort of directly of you. You're probably going to get a better result doing your own with tax software than going to a tax prep place where you don't have any personal relationship. But better is to go with an independent enrolled agent where they want to have your farm tax return, they want to have your business, or a certified public accountant that wants to have your business. Do they need to be an expert in farm taxes? That's really, really nice if they are, but it's not necessary. I'd say if they're not expert, you do want to make sure that they understand that there truly are some significant special issues for farm and ranch, and you shouldn't be shy at all about affirming that. That's not an insulting question. And if they say, no, I don't have expertise, and but I really want to work with you, say that's great. I just really want to make sure that you're willing to consult with the IRS Pub 225, the ruraltax.org resources, and these new resources from the Ag FTAP. There are lots of resources out there for any tax professional, could pretty quickly read them and pretty quickly grasp the few things that are really different about farm and ranch and integrate it into your operation. And I'm going to spend most of the rest of this presentation on these few things that tend to get missed, that you just want to flag them. And so a lot of the rest of this presentation, it's not so much for you to understand the details of what I'm saying as to say, oh, that's a thing I need to flag. And I just need to make sure that the tax preparer doesn't miss that they take the time to look up the special rule for that thing. All right, so here we go. Here's taxable income generally. The Internal Revenue Code starts with all income from whatever source derived, all of it comes onto your tax return somehow, unless there's some specific exemption. The question is, where does it go? And how is it treated? We talk about income, but what we often really mean are losses or negative income, because losses offset other income. So if you have sort of the ideal farm situation, you have one spouse who's working on the farm business all the time, and another spouse who's working in another paid job all the time. The spouse with the paid job is getting a W-2, they're having taxes withheld. The spouse who's improving the farm, building the farm business, at least in the first years, that farm business is losing money. As long as it's not a hobby, as long as it's truly an intent to profit business, the losses from the farm offset the income from the wages. That tax savings is really financially significant, either to cash flowing the family's basic living costs or to being reinvested back into the farm. So again, the IRS wants to limit those losses. First way they limit is through that hobby loss rule. The second way they limit, well, second through 29th way, there are many detailed rules about how losses are limited. So I don't want to go into the detailed rules for the loss limitations. I just want to flag for you that that's where the action is from the IRS's perspective, is when you're taking losses against other income. So here's a simplified vision of the tax formula. Wage income, interest and dividend income, capital gains and losses. Remember I said when you sold farm equipment, it's reported separately on a separate form. There it is, that's capital gains or losses. The gain or loss from sale of equipment is taxed differently than your other farm or ranch activities. The other farm or ranch activities are what's called self-employment income. Someone asked about that way early. Talk about self-employment income. Here we are. We're going to talk about self-employment income for a while. So farming and ranching or other Schedule C activities are subject to self-employment income. Capital gains and losses are not. They're taxed as capital gains. It's its own tax rate. Rents and income from other pass-through entities not subject, may or may not be subject to self-employment income. That's the tricky one. That rent and income from pass-through entities is the one that it's maybe, maybe not self-employment. You have to really know exactly what's going on. All those things together are your adjusted gross income. And then from that, you take either a standard deduction right off the table, or you take itemized deductions, which there's a number I'll walk you through what the specific itemized deductions are. That's an either or. And on top of that, post 2017, there's this new deduction called a qualified business income deduction. That relates to self-employment tax. So give me a second, I'm going to come back to qualified business income deduction, but it's a new special deduction that relates to self-employment income. That gives you income subject to income tax. Calculate your income tax on that. And then you have to add to that income tax number, you add the self-employment tax. So the tax due is a combination of income tax plus self-employment tax. And then the estimated tax payments you may have made during the year come out, and the remainder is what is due or refund that you can take home or have applied to next year. I want to go into this in a little more detail and really explain what the self-employment tax is about, because this is one of the most significant things you need to understand if you're self-employed, and it's one of the most significant things that you can plan for in doing your taxes. So think about your W-2 wage earnings. Think about the first time you got a paycheck and you were so horrified at how much smaller it was than you thought what you were going to get, right? Because they'd taken all these taxes out. For sure, they took out Medicare and Social Security. Probably your first paycheck, you were, a kid and didn't have that much money, and they weren't even taking any income tax out because you weren't going to owe income tax. But they took out Social Security and Medicare. That's your half. Your employer paid their half. Those funds went into the Social Security and Medicare accounts, and hopefully they're waiting for us there when we're ready to use them. Employee half, employer half. Now you're older and you're self-employed. You are the employee and you are the employer. And the public policy is we don't want people not paying into Social Security and Medicare because it's really bad when people reach old age and they have no Social Security and Medicare. So we want to encourage people to keep paying into Social Security and Medicare, or to start paying in, get paid in as soon as possible. So the self-employment tax puts you on the same footing as a person who has wages, paying in to Social Security and Medicare, but this time you're paying both sides. So that makes it 15.3%. And that's in addition to income taxes. Income tax and self-employment tax. So if you have modest income for the year, you might not owe any income tax at all, but you would still owe the 15.3% self-employment tax on the self-employment income coming from your Schedule C or your Schedule F, or possibly partnerships or other businesses that you're involved in. So for a long time, until the 2017 Tax Act, the first motivation of people who just didn't want to pay taxes of any kind for any reason was, let's lower my self-employment income because I don't want to be paying. That's the fastest way, right? It gets rid of income that I have to pay self-employment tax on, as well as income that I have to pay income tax on. So that's the fastest way for me to lower my tax bill. So people were very motivated to reduce their self-employment income. What the 2017 Tax Act did is it created a new deduction called the Qualified Business Income Deduction. And what it does is it says, okay, self-employment taxes are 15.3%. That hurts. why don't we give you a 20% credit against your income taxes on the income that is used to calculate your self-employment tax. So if you keep your self-employment income high and you pay the self-employment tax on that self-employment income, you get a credit against income tax that covers the self-employment tax with a little bump extra to spare. So this is an example of good public policy because it helps motivate you to do the thing that is in your best interest and in the best interest of society, which is to get at least something set aside for your future. So that's the intersection between self-employment tax and QBI, or the qualified business income deduction, QBID. Wages don't count you for QBID. The only thing that counts you for QBID is Schedule C self-employment, Schedule F self-employment, or self-employment that comes through from another entity. And the extra special bump is if you have rental income. You don't pay self-employment tax on rental income, but it can, under some circumstances, also count for QBI. So the rental income under some circumstances can be very, very tax favored. So again, this is the summary of the different kinds of income that come to you. And again, when I say Schedule F, the farm or ranch profit or loss, that's the net number, right? That's farm gross income minus all the farm expenses. Just that summary number is what I'm talking here, coming through on the Schedule F. So people sometimes talk about deductions, tax deductions, in a really vague, general way, right? There's actually different kinds of deductions. So there's the deductions you take against your farm income to come to your net farm profit. We're going to talk about those in a minute. But there's also the deductions you take against your overall family income to come to your overall taxable income. So watch carefully as I go to the next slide. So these are all the income items, and it comes down to adjusted gross income. That adjusted gross income is at the bottom of the page here. When I go to the next slide, that number is going to be at the top of the page, okay? There's the adjusted gross income. Now, these kinds of deductions are what we deduct from adjusted gross income to come to your total tax bill. Either you take a standard deduction, you just look up a number from a table, that's your number, you're done, or you take what are called itemized deductions. So I know everybody gets all sorts of solicitations from charities, right? Give us money, you can deduct it on your taxes. It's only half true, right? You can only deduct it on your taxes if you itemize on your tax return, and a lot of people do not itemize on their tax return. So you should still give to charity, but it's not really true that it's always a tax deduction. It really depends on your whole tax picture. Okay, for those of you who own the land where you farm a ranch or where you plan to farm a ranch, if you're still awake, if you're still here, pin your ears back, because this is the part that really matters and is going to save you money and make it worth it for you to have stuck it out this far, okay? Your itemized deductions on your personal income tax return are limited for state and local taxes to $10,000 per return. So that's a penalty against married people for sure. You're also limited on what you can deduct for mortgage interest on a home. Those limitations do not apply to the portion of that that is actually business taxes and business interest. You buy a property and you're only using 25% of it as your personal residence, the other 75% of it is actually your farm, you only have these limitations on the 25% of the property taxes that are personal. The rest of the property taxes that are business go on the Schedule F. They don't go on the Schedule A. And so this is a really important reason why, if you're in this situation, and we're going to talk about this some more on the other side of it a few slides from now, the details of how to separate farm and business use. But this will save you a lot of money. right? This will more than cover the cost of getting a CPA to walk you through how to do this properly. And when people do their own taxes, or don't get an engaged tax preparer who's asking the right questions, and they miss this, they cost themselves thousands and thousands in overpaid taxes. So that's the main thing I want to flag here for people who are living on a property that they're purchasing that's mixed personal and business. And again, I'm going to talk about that quite a bit more in a few more minutes. So this is the summary of how you get down to the total income subject to tax: adjusted gross income minus one of these deductions, and then also minus this qualified business income deduction is your total income subject to income tax, plus your self-employment tax. That's what you owe. I think I've covered this pretty well. This is just going back again over what does or doesn't qualify as QBI for that extra 20%. All right, so now I'm in the special rules section. So this is, I have half an hour left, right?
Yes.
Okay, good. So we're gonna just make this for some questions. All right, this is the last stuff I want to cover. This is the stuff that you don't have to follow everything I'm saying if you just flag this slide, right? These are the things that if you're using a tax preparer who's not expert in farm and ranch, be sure that you have a conversation about these items and that you're getting these items correct for farm and ranch, which could very easily be missed because they can be a little different from how they are in another business. All right, so the first one is self-rent. I'm not going to go into great detail here because this very much depends on how you're set up as an entity. But this is one of the things that would make an S corporation election make sense. So if you own your own property, whether you're living there or not, but if you own the land and you're getting about to where you might be thinking about an S corp election, the ability to pay yourself rent for the use of that property becomes significant and might kick you over to where the S corp election makes a lot of sense for you and helps you have an advantage. I'm just going to step aside from taxes for just a second and put parenthetically that the other reason you pay yourself rent is not for tax purposes, but it's for purposes of limiting legal liability. That's not a tax concept, that's a legal liability concept. But it is important for you to consider paying yourself rent and separating your operating entity from your land for liability reasons. And that's just an aside. I encourage you to think about speaking with a business attorney or possibly a personal and estate attorney about why you might want to do that. All right, here's the next topic, which is assets and depreciation. So what is an asset? I think Ashley just touched on it very briefly, but I'm going to focus on it some more here. Ashley talked about a bookkeeping system. So a bookkeeping system, what's going on behind that system is what's called double entry accounting. That means there's two sides to every transaction. Assets are one of the things that you get out of a double entry accounting system is the distinction between an asset and an expense. An expense is something that when you spend the money, it's just gone. Seed, you put it in the ground, it's not a seed anymore, it becomes a plant or it rots. A tractor is an asset, you buy it, it sticks around for a while, right? The gas you put in the tractor, it gets burned up, it's gone. The tractor remains, right? So the tractor is an asset, it sticks around. Expense goes away. If you have a good bookkeeping system, if you have double entry accounting, you have a balance sheet. And that balance sheet lists your assets, the things you own that you haven't spent, that you haven't used. And then there's an income statement, what you sold, your income you took in, and the expenses, the utilities, the gas, the feed, all the stuff that's gone. You pay your telephone bill, It's gone. You don't have any tangible leftover telephone, right? You paid the bill, it's gone. Those are your expenses. So the tax rules treat assets differently because accounting treats assets differently. They're called long-term assets. They're going to benefit the business for many years. The problem from your perspective is you spent the money this year to buy the tractor. You don't have the money anymore. You have tractor instead of cash, right? You used to have cash, now you have tractor. From an accounting perspective, that's right. The end. From a tax perspective, they say, it's not really an expense, but we're going to let you take an equivalent to an expense deduction this year. That's called depreciation. And so we're either going to let you take a portion of the tractor this year, or we're going to let you take a bonus and just take the whole tractor this year. You can choose which one. You could choose to take it all this year because you just want to minimize your taxes. Perfectly good choice. There are many reasons why you would choose to only take a fifth or a tenth of the value of the tractor this year, because you're actually trying to have higher taxable income this year. We don't have time tonight to go into why you would choose higher taxable income in some years, but if you're working with a tax preparer, tax planner, you can have that conversation. There are absolutely times when that is a benefit. So you have a choice in how you take the deduction related to an asset, but it's through this mechanism of depreciation, either the general 167 depreciation or the special 179 bonus depreciation. There are significant additional, very complicated rules that pertain to a special type of depreciation for farm assets that are particularly, they come into play when you're planting orchards and vineyards. I'm not going to get into any of that other than like the flashing lights. If you're planting orchards and vineyards, you really must see a qualified CPA and have that conversation, because these issues become very complex, I do a whole tax class just on that part of the tax code. So instead, I'm just flagging it for you. You can read more about it in the Pub 225. You can read more about it at ruraltax.org. But if you leave here tonight, just leave here knowing that there are some special rules for depreciation of farm and ranch assets, and be sure to flag that with a tax preparer, or be very careful if you're doing your own return in TurboTax or HR Block. Related, when you sell the asset, all those rules come back again. How much depreciation you've already taken is factored into how much gain or loss you report when you sell the asset. And then I'm also flagging, remember I said at the very beginning, I wasn't talking about anything other than federal income taxes. And here's my one exception. Most counties also require you to file a county property tax return, not on the land, but on the business assets. The only way you're going to get that right and survive a county property tax audit or an IRS audit is to make sure that your asset list for county property tax purposes is the same as your asset list for IRS purposes. The only way that's going to happen is if you have double entry accounting, which means a bookkeeping system like what Ashley was talking about. So here's my I flagged some of the things for you, like if this is landing wrong with you and you're thinking, I haven't done that, I'm not doing that. This is easy to fix, really relatively easy. It's really important to fix. Do yourself a favor and fix this before someone makes you fix it. It will be way cheaper to fix it before someone makes you fix it than having to fix it in a hurry because you're being audited or you have some discrepancy between the two, and it's more likely to come from the county than from the IRS, frankly. Some counties, it's a county, they've got county personnel, it's not that big a county, they've got the records, they've got the drone footage, they can see that you've got a farm, they can see that you didn't file. That's not actually hard to figure out. Eventually you'll get some sort of a notice, and they're going to want to audit to your federal tax returns, and there you go. And they're going to want to audit to your bookkeeping system. And back to the shoebox, right? The shoebox will never show those assets. Back to the Excel will never show those assets. The only way you're going to have a proper asset list is if you're doing double entry bookkeeping, where it keeps track of those assets that live for more than a year in the business, right? The income and expenses close out every year, but the balance sheet is perpetual. It keeps building year after year. So you can see your fuel expense in your business in November is very, very high, right? And then December, it's the highest it gets for the year. And then on January 1st, your fuel expense is back to zero, right? But the tractor on your balance sheet, it keeps going. It's there in 2022, and look, it's there again in 2023, because it's on the balance sheet where the things are that stick around. And that's the asset. So that's what I'm encouraging you to get that asset list straight, get it straightened out in your bookkeeping system, and make sure your bookkeeping system, your federal tax return, and your county tax returns are all telling the same story. Can be a chore to fix it, but really worth it before you grow any bigger and have any more assets. All right, this is the other tough one, inventory assets. So we're just talking asset is not an expense. Inventory is a special kind of asset. It's for something you still own at the end of the year, but it's also short-term in that you plan to use or sell it in the following year. So it's not like a tractor that's going to stick around for a while. It's kind of short-term. But the point is, you own it at the end of the year. It's not gone. It's not an expense. So first thing is that farmers and ranchers and fishers are not required to keep inventories for their growing crops or livestock, or in the case of fishing, unprocessed catch. That you could think conceptually it should be inventory. Yes, conceptually it should. Fancy accounting would make you keep it as inventory. IRS doesn't make you keep it as inventory. But you may need to keep inventory for supplies used in your operation. So if you've got, thousands and thousands or hundreds of thousands or tens of thousands of dollars worth of seed, fertilizer, packing equipment on hand December 31st for use in the coming year, there are some special rules for how you have to treat that. And here we come back to value added, and I've been talking about the C and the F, right? The value added items for sale. Whether you put it on a Schedule C or on a Schedule F, if you have a substantial amount of value added product in inventory ready for sale, but you still own it on December 31st, that's an inventory problem of some sort that you need to flag. Because they're not exempt from the inventory rules because they're not raw farm or ranch products. They're food products or other inventory products. So back to the example of the person that's selling gift items at the farm store. December 31st, you may have all the perishable produce out of the farm store, right? Maybe all the meats out of the farm store, but the gift items that you were selling are still clearly in the farm store. Right? They're durable. They're going to make it through the snow on New Year's Eve just fine. That's an example of a year-end inventory item that you're going to need to make some proper allowance for on your tax return. So the rule on supplies inventories, that's the inputs, not the gift stuff, the supplies, the fertilizer, the boxes, the bags. If the total amount of prepaid supplies is more than 50% of all your other deductions, then there are special rules. I'm not going to go into it, but they're in IRS publication 225. So I just want to flag that for you. If you have that processed inventory, or in the case of the person who asked the question earlier, the purchased inventory, gift store inventory, there's a special thing I want you to do, and I don't have time to explain it in detail, so I just have to ask you to trust me on this. You want to ask your tax preparer to be sure to make what's called a NIMS election for you. This is a protective election that says, I don't know the real value of this stuff that I'm supposed to not deduct, so here's a number that I think is close, and you can't fault me for trying. So the worst case scenario is the IRS basically has to accept that number because you've made this protective NIMS election. If you don't make the protective election and the IRS were to audit, and you didn't know any of this, you didn't know what you were doing, you weren't making any election, the way they could recalculate the tax owed could really hurt you. So it is an important protective election. And I wish we had more time to go into it, but I hope you can just get from this that I'm flagging this as a very important thing to talk to a tax preparer about if this is your situation. And I'll also just flag, because I can't help myself, that if you have a substantial amount of inventory, particularly if you have, $100,000 worth of frozen meat in your cooler for sale, you should also be thinking about if you have enough insurance on that if something happened to it. And you should certainly be thinking about a backup power source. In California, when we've had devastating fires, the farmers that I know who've been hurt the worst, the fire didn't burn their farm. They had irrigated pasture. That wasn't the issue, but they lost power and they lost their meat cooler. And that was devastating, and it took some of them out. So, I'm sure you can think of many examples of that. So that's part of the value, again, of having a balance sheet as part of your overall business management strategy, is it focuses your attention on your assets so you can think about not just are you doing the correct tax treatment for the assets, but also be thinking as a manager, are you using the other correct strategies to protect those assets? All right, these are the last few things to go through. I flag this not because it's a special farm or ranch expense. I flag it because it's not on the Schedule F. And so sometimes people think like, oh, I guess farms don't have these expenses. Not true. What Ashley said about take the Schedule F and use that to set up your chart of accounts, take the Schedule C as well, because all of the expense categories that are on the Schedule C are also available to you as a Schedule F filer. They don't have their own little line on the Schedule F. Don't get me started why. They just don't. You have to add all those manually to the end of your Schedule F. So I'm flagging this. It's a normal business expense. Any tax preparer knows how to do this, but don't skip it because you're a farmer and it's not on the Schedule F. All right, vehicle expense, same thing. I'm not going to go into it. There's a gazillion materials out there on vehicle expense. All I'm going to say is that the common way you do it is you have a business vehicle inside the business, the farm truck, doesn't leave the farm, drives around the farm, 100%, or does leave, it does deliveries, but all it does is work, right? 100% of everything associated with that vehicle is deducted on the Schedule F using the actual method, actual expenses deducted, but the owner also has a car, or the owner's spouse has a nice car, right? And sometimes the owner uses the nice car to go into town and run errands that are related to the business because they don't want to be running those errands in the ratty old farm truck. That's fine. That's normal. That's typical. You can use the mileage deduction for those miles in the personal vehicle. So I want to encourage you for yourself to just look up the rules for vehicle deductions, and then to remember that in a farm case, you would often have both. Farm vehicle, 100% actual inside the farm, personal vehicle, mileage method outside of the farm for business errands related to the farm. Meals, same thing. I'm not going to go into the rule, but don't forget that you can take meals deductions just like any Schedule C self-employed person. Just because there isn't a line for it on the Schedule F doesn't mean nothing. You are still entitled to taking these deductions like any other self-employed person. Per diems, same thing. This is, again, I'm not going into the details here. You'll get these slides. But people don't think about how to use them in the farm context, and the per diems are often very helpful if you're traveling to a farmer's market. You don't have to keep your receipts. You can follow the rules for the per diem, look up the per diem amount in the table, and just take the per diem amount for that day as a farm business expense. even though there's no line on the Schedule F for it. Education. Anything you do to improve your knowledge is a normal business expense. Don't hesitate to deduct it. The travel associated with it, don't hesitate to deduct it. Education to enter a new occupation is not deductible. So those of you who are exploring being a farmer, you can't deduct those costs, but once you actually become a farmer, you can deduct those education expenses. Okay, here's the part I promised about the home place used for business. So this is very typical. There's nothing unusual about this at all. Any tax practice that focuses on farm and ranch does this all the time. There's an allocation between the personal assets and the business assets. What you do is you get a farm appraisal, and you have this expert break out the different depreciable assets, including and the land, and then you calculate the relative value of the soils and the different parts of the property, and come up with a little map and a little allocation of what is farm and what is home place and personal. If there's permanent crops on the land, like a vineyard or an orchard, those are going to be stated as separate assets, and they may be a few of them, like, you know, the older orchard, the newer orchard, all that will be listed with their relative values. That's why you need a specialist who can do this kind of appraisal. These trees and vines get depreciated over 10 years, so that can make a huge difference in the affordability of the land if you're able to actually deduct through depreciation a portion of the purchase price because it's attributed to the orchard or the vineyard on the land, or to the fences or the barn or whatever the assets may be. So here's the action item. If this is you, go immediately to a qualified tax preparer. It's March, whatever. They're going to put you on extension. They don't have time to fix this for you this year by the tax deadline. Don't worry about it. Say thank you, go on extension, and let them work with you to get this fixed. It will save you thousands and thousands of dollars. And there's no way you won't save more in taxes than it will cost you to do it. No way. So it's really worth it. If you've already been doing this, but you haven't been doing it right, you can go back 3 years and amend and get refunds. So that'll cover your cost of getting it all fixed. You can't go back farther than that. And what's worse is you can't go back farther than that. And then if you ever sell the assets and they tax you on the gain on those assets, they're going to tax you as if you had taken those deductions. So there's really an incentive to get this right early and not wait. Office and home is related, but a little different. That's just inside the home, inside the corner of the property. That's the farm and ranch. I'm not going to go into this in detail because there's a whole Pub 5887 on how to do it. But the one farm and ranch thing I want to say is you can have a farm office where everything's chaotic and coming and going and dogs and kids and all the things, right? And then you also, inside of your home, have an office that's quiet and private, where you talk to your accountant or have sensitive HR conversations or whatever you do, think about your budget, right? You can have both. That's fine. The home office, as long as it is a place where there's a substantial administrative or management function happening, it's okay that you have both of those offices. Last topic, startup costs. I know some of you are here in that startup phase. So keep track of expenses that would be regular business expenses. And in the first year that you have income, you can make an election to deduct your startup expenses. There's a special rule in how you deduct them. It's called amortization rather than a deduction. There's some limits on how much you can take in the first year. You take the rest over 180 months. But the key thing is you have to make the election by the due date of the first return that has income for that business. One shot, you miss it, it's gone. So again, one of the things I really want to emphasize for all of you that are here in the planning phase, congratulations. You're some of my favorite people. You make me so happy. because I so often meet people who tell me they've been doing this stuff for 4, 5, 6, many years, but they didn't want to deal with taxes until they really felt like they had it together. And all I hear is they just completely lost years worth of deductions that would have been really valuable to them, and they can't go back and get them. So congratulations to all of you that are early adopters, and those of you who are late adopters, don't feel too bad. I'm just being sad with you. And I hope I've given you some good hints in this program for things to prioritize in terms of getting yourself to a place where you are consistently able to be proactive and planning for your taxes. And with that, I've taken us almost to the very end, so there's only time for a few questions.
I'll try to field some of these. It was asked earlier, but it was about the free software that the IRS offers if they have a Schedule F
You
option.
forget it. If you're self-employed, no, not happening.
Next question. So if you're buying or selling cattle, do you need to keep inventory on how many you buy and sell, just inventory and feed?
Cattle's a tricky one. So in the interest of time, first I would send you to Pub 225 where this is explained in detail. There's lots and lots of resources through ruraltax.org and through the Pub 225 on cattle. It's a little tricky with all livestock. There's livestock, breeding livestock, and livestock held for sale. And they're treated very differently. So that's a whole other tax class. So I'm just going to flag that as please go do a little bit more exploration, because it's treated two different ways, and you do need to wrap your head around those two different ways that cattle may be treated.
Very good. Just three more questions. Can we do cash basis instead of inventory basis?
Yeah, that's a good question. And it used to, that question speaks to the heart of what is some of the most complicated stuff in tax accounting right now. Everything about that question is complicated. The definition of cash accounting has changed. The definition of inventory accounting has changed. I really can't answer that question quickly because it is a very fraught legal question. So I have to just say for tonight, keep it flagged and definitely bring that to a tax expert, or go do a little bit more research and look for more resources to be coming. Over the coming year, we will definitely be providing more resources on that very important and complicated question. But for now, NIMS election is your friend. Cash basis or not, NIMS election is your friend, and have that conversation with a qualified tax preparer. And it may mean there's nothing wrong with going on extension. If you have a real tax issue that I've raised tonight that you don't understand, but you think it applies to you, going on extension and getting it right and fixing it over the summer is a really solid plan. I really encourage you to do that, because you won't get a good tax preparer to pay you attention this time of year, but they can help you over the summer get straightened out.
And then is a NIMS election for any item left in inventory, or even if they're not perishable?
Yeah, it's definitely not just for perishable. I mean, I would say if it's perishable, you can kind of forget about it because it's going to just perish. It's for non-perishable items in inventory. Last thing I want to say, since I feel so crunched for time, and I'm sure there's a lot more questions, is we're going to be posting this presentation. Maybe Kelly, you can speak to where this will be posted. And I'm thinking that if there are leftover questions in the chat, you could email them to Heather, and we can make sure that they get addressed in some form and maybe posted as a follow-on to this presentation in the same place.
That would be great. And I'll just close out by thanking both Poppy and Ashley for speaking with us today. I know it's late, but obviously with the amount of people that we had attend and that had signed up that will get the recording, there was a lot of interest in this. So we all do really appreciate that and all your time. We will send out the recording for this. Also, the slides will be available once they're updated on the website that's in the link in the chat box. And then we'll also, Heather will be sending out an email for a survey. You know, a lot of this work is grant funded, and so there are results that need to come from that. We need to be able to prove that people are learning something. And if you're not, then we need to know that too. And so if you can fill out the survey, that would be really helpful for everybody. So I will take a screenshot of all the chats and we'll try to address all those if we didn't.
I was going to say, let's make sure we capture the chat so I can make sure that we get it added to the
I've actually
slideshow.
saved it and downloaded it.
Thank
So
you.
we'll get that to each of y'all.
All right. And with that, it's 8:30. So I'm going to end it for everybody again. Thanks so much for everybody.
Thanks,
who
everyone.
attended.
Have a good night.
All right. All right, Colin, you got everything you need?
Been talking while being muted,
I'm
haven't
just
I?
scrolling through these chat before we go just to see what was going on while I was talking.
Yeah. So
I really
I
only
know.
think there was one question that wasn't addressed, and it was very specific about
Yeah. I'd
uh,
still love to see the chat because it would also help me just know like what's out there, and it would just be a good exercise for me to make sure I cover some of that stuff. Thank you. It was an interesting group. I could tell from what little I got that it was an interesting group.
Man, I learned
right,
a
thanks.
lot.
right. Bye, Poppy.
Hey,
Thank you.
I had a quick question
Good.
real
Yeah.
before you go.
Yeah.
So you're talking about that hobby law when you're having to prove to the IRS this profit, intention. And when I
Yeah.
think of that, I think, well, the IRS only wants to see the numbers. They only want to see financial documents. But could, like, let's say one of these farmers had gone to like a small business innovation center and developed a farm plan, or they worked with a consultant and had
yeah.
a plan. Is that something that could be used to prove?
Absolutely. It's actually the hobby loss rules. There's like 9 or 12 things they'll look at. And the rule says everywhere, no single factor is determinative. Okay. But when you're talking to Poppy Davis, she's going to tell you that the single most important thing you can have is bookkeeping.
Right.
And I'll let a judge disagree, but they will absolutely look at all those things. And if you don't have the bookkeeping, but you have all the other things, you could possibly get the judge to be on your side. But I'm just saying, if you have the bookkeeping, it'd be a lot easier.
Yeah, but in addition to bookkeeping, then
you're golden. Then you're golden. If you've got all that, a business plan, bookkeeping, it's open closed, you're good.
Very good. Well, I'm going to try to find this file. If it downloaded, it may have downloaded to Ryan since he's actually the host. So if I can't find them, I'll get in touch with you, Ryan, but we'll at least have those out by tomorrow.
Great. All right, thanks again. I hope I'm asked back sometime. It was a fun group. I could tell, even though I got the vibe through the Zoom that it was a good group.
I think so too.
Have a good night.
Thank you so much.
All right.
Take care.
Bye.